Hello, folks. Brandon Chapman with you today. It's another video from TheoTRADE. It's the Wednesday. Boy, it's May 29th, getting towards the end of the month. It's about summertime. They did say sell in May and go away. Is this finally being realized for the market today? As we look at the S&P 500, you'll notice we're down about 0.7%. This isn't a lot necessarily. The range today was very anemic at less than $2 on the SPY. And you go to studies and edit studies here on Thinkorswim, you can see the ATR. If we say okay, it is around 458. We take the close from yesterday, 529. Again, closing today at 526. You kind of say we're about $3. No matter how you slice it, today wasn't necessarily all that big, other than the fact the market went down. But it was how we went down and why and the breadth. You look over at the sector performance, all 11 sectors are down. The S&P is, of course, down. And notice the S&P is towards the upper end of this list, with energy being battered the most and continuing its downtrend. It really looked like yesterday we're setting up on energy to see a breakout, possibly from a falling wedge. If we notice here, if we just bring up my drawing tool here, you can see lower highs, across the top here. You can see, we're kind of maybe starting to, inch in here. If we go off the low there, it looked like we were kind of, starting to bottom here, at least in the near term in energy. Maybe we get a bounce. And if you look at forward/CL, oil prices got a nice lift yesterday. But boy, it just seems like, we're talking about the current market. The threat of the dollar rising is a big problem right now. And of course, that's being reflected in gold prices, forward/GC, for example, kind of gapped open here. We're selling off throughout the course of the trading day. Look at GLD, you can see the cash session and see that kind of drop here in today's session, down about 0.9%. The dollar is starting to strengthen, and we saw that last week with commodity prices getting hit. We're seeing it today with commodity prices getting hit. And of course, does that cause Nvidia to fall by the wayside at all? Not really, but really only was able to muster a 0.8%, less than 1% gain today, which, given the recent trend the last several days, is pretty phenomenal. That's all it got. But the question becomes, what are the existential risks? What are the risks outside of just equities that could potentially influence the market? Certainly a stronger dollar. And the other one today was TNX-CGI. This is the symbol for the 10-year on Thinkorswim. Yields were rising today. We saw a couple of bond auctions, did not go so well. We kind of finished near the high yield of the session. Remember that bond prices and yields go opposite directions. So if yields are going up, prices are going down. And this creates problem for like regional banks. It creates problems for real estate. There's a breadth of areas, even utilities should be affected negatively. And if you look in here, you'll see again, apart from like the cyclical, energy materials, you can see that utilities, real estate, and financials were among the lower end of things, down nearly 1+% today. And so what you see is that there is risk right now. And you look at financials. Financials are coming off the highs for a little over a week. Certainly areas of the market are showing more weakness. Technology is yet to break, but again, you see other areas. You're seeing there's much more of a coming off in terms of prices, and that really kind of reflects the divergence we're seeing in the market right now. Don's talked about it a fair bit. Is that again, we're kind of seeing things getting fractured. And what we really began to notice last week, and you can see this in the SPY, this was on the 23rd. Again, that was what? Last Thursday, last Friday, the 23rd. Yeah. No, sorry. We had a holiday in there, didn't we? Last Thursday. If we look at NVIDIA, NVIDIA announced earnings on the 22nd, and it produced a rather sizable gain. And what you began to realize is that, have we finally been disconnected from NVIDIA? The market didn't get any gains on that 10% move in NVIDIA. The broader market did sell and drug it down. Even big components that have generally been relatively sympathetic, like a Microsoft or an Apple, for example. Apple did come off the lows the last couple of days with news, maybe more iPhone shipments to China, whatever. They're made in China, so how do you really ship it there anyway? But point being is that there's been some ugliness, and there's been kind of this fracturing that this kind of tie that if Nvidia does well, everything is good. It's that box with the guarantee on it in Tommy Boy. And what we're seeing is that guarantee may not be providing the solace you want. And principally, what's really hurting the mark right now is the fact that yields are rising. Now we got to examine, well, why are yields rising? In part because inflation concerns have not dissipated. They've not yet gone away. The fact of the matter is that inflation may come up back up again, but certainly there might be fear on the part of foreign investors, foreign holders of our debt, to want to buy more. Foreign holders of dollars wanting to buy our debt. The Congressional Budget Office, discussed the fact there's basically $700 billion debt deficits annually, as far as the eye can see. How much can we continue to rely on borrowing from the world, right? Not producing as much here as we probably should because of maybe very stringent regulations that limit productivity. It's cheaper to do it elsewhere, more productive to do it elsewhere. And so as a function, we're just consuming more than we produce. And as a function, we send dollars for goods. Those foreign holders of our dollars, China, Japan, whoever, then could potentially buy our debt to continue investing those dollars, or they could buy our property, they could buy companies, etc. But the reality is, I think what we saw today is that there is some fear over our debt by foreign holders to want to buy more, and that kind of heaps more on the bigger primary dealers. Of course, the federal government, the Treasury, did discuss in their kind of quarterly refunding the fact that they're going to issue some debt to basically buy bonds back from primary dealers. Again, takes some of the toxicity off their balance sheet, recapitalize them to some degree. Again, there's a certain amount of loss. And again, if they went to sell those bonds, what would happen to the Treasury market? What would happen to yields? And again, nobody really wants to see that. And so we're seeing some pressure being born, and with all sectors in red, it says that it's distributed pretty evenly across the markets. The trend is not distributed evenly, but for today, again, we're seeing everything is in the red. And I'm going to bring up kind of a reflection of the breadth today. And so what I'm going to do is I'm going to take declining against advancing issues. So this is $DECN plus $ADVN. And I can take a ratio or a relative strength line of the two using the pairs ratio study. And as we look at this, we're not worried about adding those two together. We're worried about the ratio. The ratio would say is about 5 times more declining issues than advancing issues. If we look intraday, can we see a bigger trend? At one point, there was over 10 times more stocks declining than advancing. There was a lot of breadth to the selling today in terms of advanced decline. Well, what about volume? So we're like down volume versus up volume. This was over 8 today. Okay, now you might look at that and say, well, yeah, that's pretty bad. So as a function, isn't that kind of bullish? Yes, to some degree it is, right? I'm like, you see heavy enough selling and the market doesn't break. But the canary in the coal mine, and the whole scenario of the canary in the coal mine is that miners that have canaries they take in the coal mine, the canaries would die before the miner did. So they knew something was wrong. The thing that is not going away, that is persistent, of course, is the 10-year Treasury yields, right? The yields on Treasury bonds continue to rise, kind of setting that baseline, causing more pressure in high yield credit, which was down today. LQD. Now, these are not down quite as much in part because why? Well, a 10-year or particularly a 30-year bond, the duration's bigger, right? The impact due to changes in interest rates are bigger in terms of price. And so, yes, you're insulated a little bit in terms of HYG by just adjustments to just the price of a Treasury bond. But remember this, is that we've yet to see, and right now, the spread between corporate credit and Treasury bonds is about the lowest it's ever been. And so there's not much of a risk premium being factored into corporate bonds right now. And many of these companies borrowed in 2020, 2021 with very low interest rates. And right now, again, the spread's really tight because the Fed created kind of a moral hazard as they stepped into the corporate bond market, buying junk bonds, buying standard investment grade corporate bonds, buying bond funds. They stepped in. They've kind of created this moral hazard where now all of a sudden we're not pricing in the same kind of premium. But again, there's the chance that we might, right? But at a minimum, if treasuries continue to sell off, you're going to see some pressure on the corporate bond market, which means companies are going to have to borrow at a higher yield, which is going to impair or impact earnings. As we see inflation concerns continue to rise, we may see again employment costs continue to rise. It's more difficult for these companies to take on a lot of debt to try to replace workers with higher interest rates. And what we saw from the Fed minutes last week is that there is a chance that there are some that want to continue to raise rates. So we're kind of stuck in a pickle right now where the Fed is somewhat incapable of really navigating the climate that we're in. And at the moment, again, there's the chance that yields continue to rise. We're currently at 5.25 to 5.5%. We're about 3/4 of a point below that right now. But again, certainly seeing 4 3/4 that gets you about 3/4 of a point below the current kind of target range, upper end of the range. Could we go to 5%? And this is where it gets interesting. A lot of people talk about the inverted yield curve, which at the Fed funds rates up here, the 10 years down here was down here at 3.8%. Yes, we're inverted, right? The entirety of the Fed yield curve is inverted. They're below the Fed funds rate, below 3-month T-bills. And so as we look at this, you can say, well, normally as we enter recession, what happens is the yield curve uninverts, the 10-year gets above that kind of 5.25, 5.5% range, or the Fed starts to cut rates, one of the two. There's been multiple examples over the last 20 years where one, we saw yields spike, the other we saw the Fed cut rates, but you generally see the yield curve uninvert during one of those processes. And look, if prices continue to move, if the dollar does not materially strengthen, what happens, right? We start to see prices continue to rise. Commodity, like for example, copper prices surge, took a hit last week with the stronger dollar. So right now we're faced with a really difficult point for the broader market. It's the fact that, look, we could go higher on the prospect of lower rates. The Treasury market has to kind of go along with that. Yields can't continue to move upward as quickly as we are. And what we're going to see is a weaker dollar, stronger gold, and other commodity prices. The other scenario is we start to see weakness. We start to price in more of the likelihood of recession, a Fed rate cut based on that weakness. And what happens is we start to see the market break to the downside. We start to see a stronger dollar, and that starts to place additional pressure on the broader market. And is there any evidence in the options market that is used to hedge that suggests that the downside risks are pretty prevalent right now? Well, if we look at the VIX, you'll say, well, yeah, but the VIX was down here at below 12 at one point last week. We kind of bumped up today about 14.25, but this would suggest there's low volatility expectations. But the reality is, remember, the VIX is inversely correlated to the S&P 500. When you're down here at 11, it means we've already rallied a lot. And so it creates risk to the downside. And the best way to kind of see that risk is by looking at the 3-month VIX against the 1-month VIX, 3 months versus 30 days. And what you'll notice up here last week, this touched about 1.19, right, on a closing basis. We got a little closer up here intraday, I believe. We'll go to 5-day, 5-minute. And you'll see we kind of jumped up here for 2 consecutive days, both on Thursday and Friday, where the 3 month was about 19%, over 19% higher, the 30-day VIX. I know I draw my line at 1.2. We got really, really close up there. Basically, what this is suggesting, the market's expecting higher volatility in the near future. And as a result, looking at what happened last Thursday with the S&P after NVIDIA's earnings, seeing that disconnect, I talked about, we walked through, it wasn't quite as ugly at that point on Thursday, but we walked through the notion of, hey, look, if you're long, we've had a pretty nice rally in the market. You might want to take some profits. You also might want to consider hedging. And when you look at the market, how do we know whether larger institutions are hedging? Just look at skew. If skew is rising, it tells you something, right? If skew is rising, it's saying that hedges are being put on. Notice where we've gone here from about 133, which by the way is historically high, to 156 on Thursday we dropped, Friday we dropped a little bit yesterday to 152, but skew is very elevated. What causes skew? Buying puts and selling calls. and the VIX is declining as this is kind of happening, as they're selling more calls and they're buying puts. And so as a function, we're seeing a significant amount of hedging taking place as the VIX is falling. And this does not give you that kind of happy place feeling, right? This suggests the market has significant upside. What this suggests is we're heavily skewed in a downside potential move. Yes, we can claw our way higher, right? Higher skew means you have a higher frequency of above average days. Yes, we might claw our way higher here, but expect those to be small, with the tail risk being very significant. And this is very, very difficult to manage, right? You can have stop losses on trades, you can have an exit strategy. But what happens when you see a major selling, you see slippage, right? You see gaps. Very difficult to control your risk in those circumstances. And so as a function, this is just saying, look, institutions are reducing their exposure. Should you? This is a decision you have to make for yourself. And yeah, you can point out ANF, has massive short interest, got a huge short squeeze today. Yeah, there's these opportunities out there, 24%. You say, well, yeah, the earnings came out, beat expectations, but this is about the shorts getting squeezed. Nearly 20% short interest. The short ratio is over 4 days. Again, these are the anomalies. We've kind of went over in my sessions last couple weeks some short squeeze opportunities, and some of them played out well. This is another one, just earnings creating a short squeeze. Is this going to hold up here? Are the fundamentals of ANF great? Again, that's something to examine. But again, you can say, well, these exist. Stocks are going up. Look at NVIDIA. If these stocks represented the market as a whole, if these stocks represented the economy as a whole, that'd be one thing. But they don't. And so this is a point where you got to recognize the risks, okay? And the risk right now of a large move are to the downside. And so if we look at the SPY, generally speaking, maybe you think we can get to 600, for example. Great. What's the downside potential? 400, right? For every amount you try to look at the upside, the downside risks are greater. And that's why skew is where it is at the moment. And it's pricing in significant downside potential. And I'm not saying to short the market. I'm just saying, look, you might consider taking profits and reducing your exposure. And of course, we have hedging strategies like the VIX volatility spread. In fact, Don went over one yesterday, buying the 14 and selling the 20. And we're now kind of breaking in here with the big move. Man, if we see a further sell-off, those kinds of spreads and using skew in your favor are things that we use. We have risk twist spreads. We have the atomic hedge if you have long equity, right? If you have an equity part of your portfolio, we'll show you how to buy puts and sell call spreads to reduce that portfolio risk. And this is the point where you might want to consider doing that. Take some swings, keep it limited to the upside. Again, we've experienced some downside in some areas I've been calling out for a while. On the bearish side, IYR, KRE, as just specific real estate, home builders as well, XHB or ITB. These are going to be very directly affected. So we start to break support levels. It's really easy to buy those put spreads out of the money. They're cheap. The skew is beneficial in most circumstances. You can buy the lower vol option, sell the higher vol option, and construct those types of trades. But today, American Airlines down, can cut their kind of forecast as well. Really hitting the sector. What you saw today in the options market was a lot of rolling, basically trying to capture profits or rolling down to keep their position connected to the price. And so a lot of that was going on. Hedges being purchased, like in the SPY, large hedge being purchased. Energy is XLE is an example of a roll down where you had a call, you roll it to a lower strike price just to try to keep it connected. It was 100, got rolled down to 93. So again, there's still upside opportunities. And again, we're kind of going one to two directions here, right? Either the dollar weakens, we prop things up, commodities probably lead out to the upside, and the craziness in NVIDIA maybe continues, or the dollar begins to strengthen. Bond prices continue to decline, yields continue to rise, and the market sees additional pressure to the downside, and we start to find that point of capitulation on the sell side with a much higher VIX. And so that low from last week, last Thursday at 524.72 is going to be something to key off. If we start to break that level, we close below it. We're now searching out other levels. I've got some yellow lines here where there's some large prints, certainly 515, 516, 511. even drifting back to 495, we're going to find that where that next level of support comes and where the trend begins to turn. But that day last week really put in perspective that we're not as connected to the trend in NVIDIA as we once were. And again, I think today is representative of that as well. And we're at a key level here that we'll watch in the coming days to see things break. Anyway, folks, we'll catch you back on the video on Monday. You have a great one. We'll see you then. Thanks.